Thank you to the Alan Turing Institute for organizing this. I'm grateful to be here. So today I'm going to be presenting a paper about leveraging digital public infrastructure for responsible and inclusive digital lending in Africa. Like they've been introduced, I'm currently at the Upanzi network at CMU Africa, where I work as a research associate. So I'll start by defining what digital lending is. So digital lending is basically accessing or borrowing money through your mobile phone. And now when we go to digital lending, responsible digital lending, this tries to ensure that this digital lending process is done in a fair manner, transparent manner that ensures that no harm happens to the borrower. So currently, digital lending is on the rise in Africa, and there are two types. There is USSD-based digital lending, where basically you put in a USSD code and you're able to access a loan. And then there is also mobile app-based digital lending, where there are different mobile apps that someone downloads from the different app stores, Google Play, Apple Store, and then you are able to get a loan. As you can see from the picture, you just select an amount, you're given a loan time period, installments, and then you can easily access that loan. So like I had mentioned, digital lending is currently growing in Africa, and this has been driven by the lack of access to traditional banking. Imagine a farmer in the village, they're trying to access a loan, maybe they want to pay tuition for their kids, but they don't have the collateral, they just have a small piece of land. And they cannot maybe go to what we call a traditional bank, so they resort to these digital lending providers who provide small loans. And it has also been driven by the increased smartphone penetration and internet access in Africa. Now, this has had a positive impact or effect. It has led to what you can say financial inclusion. These underserved populations now have access to credit and financial products. Like I had mentioned, the farmer who previously couldn't get a loan from the bank, he can now get through these. So now we ask ourselves, how can we make digital lending responsible since we have achieved financial inclusion? So this has also had some risks, some impacts and challenges. Digital lending remains largely unregulated because of its rapid growth. And also this has exposed consumers to predatory practices and high interest rates. So the main challenge is that the current system is highly fragmented. There is a lack of standardization. Different practices among different lending platforms have created a fragmented landscape. This is mainly in terms of KYC and credit scoring. Like I had mentioned, there are different apps, and all these apps do as they wish. They all have different models that they use to operate. They do KYC each in their own way, and method and credit scoring is done how they wish. So one of the ways that credit scoring is done is through data collection. So one of the challenges is excessive data collection. So most of these apps, as soon as you download the app, they have access to all your SMS messages, all your money transactions, and this is what they use to do the credit scoring, which you can say is something, it's not privacy, from a privacy perspective, it's not good. And also, like I mentioned, there are current regulatory gaps that have left significant loopholes that can be exploited. And also there's the issue of over-indebtedness. So someone can download over 20 mobile apps, and then they acquire loans from each of those apps. Now that creates a debt spiral. Someone has debts from over 20 mobile apps. They're also now using their telecom provider to access loans, and there's no way of monitoring this. So you can easily find citizens or members of the population going into a debt spiral. So now we go to the solution. The solution, we think, is digital public infrastructure, DPI. One of the speakers had briefly described DPI. You can say it's a foundation of digital systems and services that enable secure, efficient, and inclusive access to different services for citizens. And for the components or pillars, we're going to focus on the three: digital ID systems, digital payment infrastructure, and data sharing and exchange protocols that promote interoperability. So as a case study, we'll look at India's DPI system. As you can see it, the data flow diagram. You can see there are lenders who provide the loans, then the borrowers who request the loans, then the ULI central system, unified lending interface, and the data sources. So the way this works is the borrower will submit a loan request to the lender, then the lender will now submit a data request to through the ULI central system. Now through this data request, they'll request for the different data they need. Now this ULI system will now fetch for that data from the different data sources. You can see there is Aadhaar, which is India's digital ID system. This is mainly for KYC or identification and verification purposes. PAN, land records, and also account aggregators, which shows everyone's financial information. Then when this information is retrieved, it's now sent back to the lender, who will be able to make an informed financial decision. A credit will now determine the credit worthiness of the borrower, and they'll proceed to disperse the funds to them. It's important to note that all this is done with the user's consent, the borrower's consent. They have to consent to all this data being retrieved. So how can we apply India's DPI blueprint in Africa? So like I've mentioned, they have successfully integrated the three pillars: digital ID, payments, and data exchange. And one of the key success factors has been the strong government support, public-private partnerships, and also a focus on user-centric design that has prioritized security, meaning the system is secure, and also ensures privacy. So this is a blueprint, something that can be adopted and implemented in Africa. And yeah, sorry. So how DPI can enable responsible lending in Africa? So these are the three pillars: digital identity, digital payment infrastructure, and data sharing and exchange. So all these three pillars work hand in hand to achieve or solve the challenges that I had earlier mentioned. So digital identity can help in KYC through identifying and verifying the users who apply for the loans, to ensure there's fraud detection and mitigation. Then the data sharing and exchange can help in debt monitoring, can enable the government and the people themselves to monitor their debt, credit scoring, by looking at someone's financial information, their bank history. We now have a more effective way of carrying out credit scoring rather than relying on SMS data, which is not good from a privacy perspective. Then also privacy and more user control. Users can choose what data they want to be shared with these lenders through the data that has been retrieved. So it goes back to what I had mentioned, by harvesting SMS and call logs without the user being aware, but here now they have more control over the data that they share. And also there's consumer empowerment. Users now have, the borrowers now have more insights into their debt, their financial history, and now they can be able to make a better informed financial decision. If I go on the portal, on the dashboard, and I see that I've accumulated debt of this and this from these sources, it makes me consciously aware not to pursue. Maybe I want to get another loan. I'm now more consciously aware, and this is the consumer empowerment. So this is not a pipe dream. There's already DPI in Africa that's being implemented at different stages. But you can see back here, these are the three pillars. So in terms of digital identity, several countries like South Africa, Kenya, Cape Verde, etc. have implemented digital IDs. Payment infrastructure, countries like Ghana, through their Ghana Interbank payment and settlement system, are doing the digital payment infrastructure quite well. And also the data sharing and exchange, the Benin's unified exchange platform and Namibia's NAMEX. So they share data between government agencies and different private sectors. So as part of the recommendations, strategic steps for implementation is to operationalize eKYC through the digital ID systems and also make it mandatory. This can be achieved through policy, and also build systems that aggregate user financial information for effective credit worthiness assessment and also preventing over-indebtedness. Before someone's loan is approved, the lender is able to see if someone has a lot of debt, meaning they're risk. Also build fair, standardized credit systems that rely on this aggregated data rather than data that the user has not authorized to be shared. Also embed privacy by design through consent-based data collection, and also draw lessons from other countries such as India and see how best to incorporate the model that works best for Africa, and also foster multi-sector government cooperation and governance. So in conclusion, DPI can enable inclusive access to credit by ensuring that the marginalized communities have access and are not left behind. It can also ensure responsible lending practices and ensure that the borrowers are not subjected to predatory practices by the lenders who are just chasing profit. And also there's enhanced debt visibility. Someone is able to make enhanced financial decisions and reduce the likelihood of over-indebtedness by just looking at how much debt they have accrued over a certain period. Then also this will lead to trust in financial systems. The lenders will have trust in the borrowers, and the borrowers will also have trust in the lenders that they are giving the money. After performing the KYC, one can be sure that, okay, this person I've lent the money to will pay me back, and also the borrowers will know that the person I've borrowed money from is ensuring that best practices are followed. Yes, thank you.